you say don't be selling it to get $4,100 an ounce in cold hard cash. Buy more at this price?
Yeah, first of all, Liz, spot silver is at $52.20. It's actually, you're quoting December futures,
Correct.
which are normally above the spot market. They're actually below. I think we're setting ourselves up for a huge short covering rally. But this is an all-time record high for silver. It's eclipsed the peak from 1980. Now, not adjusted for inflation, but just the nominal price is now higher than at any point. And in fact, gold year to date is up 56%. Silver's up more than that, but gold's up 56%. That is the biggest one-year gain since the 1970s. And we still have 2.5 months left. But when gold started to move like this in the 1970s, it was the beginning of a huge move. Gold went from $35 an ounce when we began the decade to $850 when we ended it. So I think this is the beginning of a much bigger move in both gold and silver. And, first of all, what it tells you about the stock market, the U.S. stock market's really been in a bear market for 26 years, because in 1999, the Dow was worth 45 ounces of gold at its peak. It's now worth barely 11. So that's a 75% decline in the real value of U.S. stocks measured in real money. But I think what we're seeing now is a warning sign, similar to the warning that we got in 2006 when subprime blew up. That was warning about the financial crisis that hit the following year. I think what we may see next year is a U.S. dollar and sovereign debt crisis. The world is divesting of U.S. dollars. Central banks are unloading dollars in treasuries, and they're buying gold. And I think this means the U.S.'s ride on the global gravy train is coming to an end, because we base our whole standard of living on the dollar's reserve status. We use that to consume more than we produce and to borrow more than we save. And when the world doesn't want our dollars anymore, we're not going to get their goods. They're not going to loan us money by buying our bonds and our mortgage-backed securities. So Americans are going to be looking at much, much higher consumer prices, much higher interest rates. And this sovereign debt and currency crisis will make the 2008 financial crisis look like a Sunday school picnic.
Well, gotta look forward to that. Peter, when you joined us, September 18th of 2024, because you've been with us since then, but you had first recommended a company called Agnico Eagle Mines, ticker AEM, and you also like Pan American Silver Corp. So this is more than a year ago. If you look at how they have exploded since you recommended them, are these a good play if people can't afford $4,125 gold bars or an ounce?
Well, first of all, you don't have to buy a whole ounce of gold. You can invest whatever you want. You can buy gold ETFs. You can buy fractions of an ounce. And silver, people can buy silver $52 an ounce. You can buy plenty of ounces of silver. We sell silver and gold at Schiff Gold. But I really like the mining stocks. Pan American Silver is probably the highest quality of the silver miners. It's not up as much year to date as like a Coeur d'Alene or a Hecla. But if you look at a longer term chart, Pan American didn't go down nearly as much as those stocks did. So it didn't have that lost ground to make up. But it's a great quality name if you're just going to buy one and you want less downside risk. Agnico Eagle also hasn't done as well as some of the lower quality miners in the last few months. But zoom out, it's been a phenomenal stock. Okay. AEM right now is $171 a share. I've owned it for 20 years. I bought my first shares below $10 a piece. So it's been a huge winner in the gold space when a lot of other gold mining companies were having a lot of difficulty. But pretty much now you could just throw a dart. I don't see how you don't make money buying any gold stock or silver stock. I think the whole group is ridiculously cheap. And the earnings are exploding. There's no other sector of the market that has the earnings growth that gold and silver companies have. And Wall Street has completely missed the boat so far. They haven't been invested. In fact, a year and a half ago, they were putting sell signals out on the mining companies because when gold was at 2,000, they thought it was the top. They said that there's no upside in gold. Well, it's more than doubled since then, and Wall Street still hasn't really embraced these names. Now, I'm just starting to see, for the first time, I've been in the financial industry for 35 years. This is the first year that I've seen any firms, like Morgan Stanley came out and said maybe the 60-40 portfolio should be 60-20-20, with 20% gold.
Right,
so
right.
I think investors are just starting to buy.
Our gold company is earning a lot of money right now. Absolutely. The margins are as fantastic as I've ever seen in my career. Yeah. Is that a warning sign that the price is too high and maybe costs will catch up, or are prices of gold still too low and they'll go higher from here? You know, right now you would have to say that just on that metric alone, gold companies are probably over-earning in terms of their profitability. When you then do the analysis and say, what does gold buy you? Yeah, so what does gold buy you in real life? And we've done this analysis, we've shared it and things with
Don't
you
have
guys.
this conversation with my wife, by the way.
Yeah. And, you know, if you want to go and buy a Big Mac or burgers or low-value goods, you can buy more of them today with gold than you could have done in the past. But if you want to go and buy a pretty standard item, say in the US, like a Ford F-150 pickup, you can't. You're buying less of that, even at today's gold price. So gold has preserved its purchasing power for some items. It hasn't preserved its purchasing power for all items, like Manhattan property, the average property price in Manhattan. You can buy way less of that. So has it kept up with everything? No. So therefore, on that metric, excluding the first one, it's not overpriced, because otherwise you could buy everything with less gold than you could have done in the past. And so I think, you know, you've got to look at these different metrics to decide where the price is itself. But I still come back to this trend, and you mentioned momentum. Momentum is very important here. So maybe you have some speculators riding on the journey in the interim, causing volatility like we've seen today. And maybe some of this physical leasing is part of that. But actually the trend is probably your friend in this environment. And if we are going in this direction, hopefully slowly, we don't want to crash. If we are going in this trend, then, you know, where could it go to from here? You know, it could go a lot higher if we're actually repricing paper currency relative to real assets, and there's an issue around people believing in it, then, you know, this currency aversion trade, you know, could last a while.
I mixed my commodities metaphors earlier and said that there'll be some splitting of the wheat from the chaff. But, you know, with the debasement trade, does it worry you that it's kind of unspecific at the moment and this momentum is just driving at anything that isn't sovereign debt, that isn't currencies? And do you think that actually, you know, Anna's talking about the silver bars and the shortage here in London, that actually, you know, gold is the one you can rely on and some of the others will suffer in the future, the near future maybe?
I don't know. I've always said when I come on here that silver and gold are very different. You know, silver's an industrial commodity, solar panels and so on. Gold's a monetary commodity. And so they have very different dynamics that sit behind them. You look at the silver market today, there's something going on in the lease market. There's a shortage somewhere. Someone's paying to get hold of it to meet a commitment. That's all that is. It doesn't mean that the price is too high or too low or where it is right now. But I'm actually excited by, you know, the profitability of the underlying companies, which is what we invest in. And, you know, at these prices, these companies are earning like enormous margins, absolutely fabulous margins. Is that priced into the equities? And you might say, well, oh my God, Evie, the stocks are up 100% this year. How could they possibly be cheap? That's staggering. They've never been cheaper than they are right now. You know, and we're starting to see the market catch up with that trade.